2021 has been a record year for IPOs, with 279 companies raising $104 billion so far, and we still have a quarter to go. But the names that have gone public the traditional way have underperformed the companies that have hit the markets via direct listing. So names like Spotify, Palantir, and Coinbase have widely outperformed the S&P and the Renaissance IPO ETF from their opening trades. And while access to those companies when they're still private is usually reserved for institutional investors, there's one company that's granting access to individual investors. Joining me now is Greg Martin, the co-founder of Rainmaker Securities. Greg, it's good to have you here. Tell us sort of what you guys are doing and why you think it's so important to help people get access.
Well, thank you, Kelly, for having me. So Rainmaker Securities is a broker-dealer enabling a marketplace for private securities transactions. So we help investors to access these companies before they go public, as much of the growth lately has been occurring in the private markets. And by the same token, we enable employees and shareholders of these companies to get early liquidity while the company is still private. So we create this marketplace for private securities transactions.
Are we talking high net worth or accredited investors or the general public?
You know, we enable all sorts of investors, from the biggest investors in the world to some of the smaller investors, to access these companies. We have a variety of techniques. We have nearly 60 reps on our platform, and we're one of the largest market makers. And so we really enable a wide swath of the population to access these companies, which heretofore were very difficult to access.
Does that give you a point of view about the manner in which these companies go public? So, for instance, direct listing versus SPAC versus traditional IPO?
It's an interesting question. I mean, you mentioned a couple of the successful direct listing companies. I mean, the reality is companies that choose to direct list probably already are great businesses and they already have a great following. And so that's probably one of the reasons they're successful IPOs. Otherwise, they wouldn't choose to go public via direct listing. Generally, we see all sorts of companies. Companies ultimately need to be public company ready to go public. And so we do get a lot of information, seeing how the companies trade up, seeing the types of investors that access these companies in the private markets. And so it does become a good indicator of how successful the companies will be in the public. So we are in a good early view of how successful these companies will be as public companies.
Yeah, I guess one final question on this, and then I do want to get to some valuations you guys have been following. But if the direct listing is becoming sort of the elite way of going public, you'd have to think it might attract companies that wouldn't otherwise qualify, so that they might enjoy that halo effect. So I wonder if it would undermine its own success.
Yeah, I don't think so. I think the companies themselves have to stand on their own. I don't think the direct listing creates the quality of the company. I think the quality of company creates the success of the direct listing. And as you mentioned, the companies you suggested, they're all great companies. They're great followings. They're well known. They didn't need the traditional marketing exposure that would come from a traditional IPO, and that's why they've been successful. So I don't believe a direct listing is going to create a great company in the public market. I think the opposite is true.
Let's kind of pivot to SPACs now, which DealBook had a nice write-up this morning about how sort of law firms and others are trying to come out in defense of the SPAC, which has really not gotten itself a great reputation. What's your own opinion on them?
Again, I think a company that is public company ready will determine its own fate. And I think one of the challenges is there was a lot of money raised early, in the last 18 months in the SPAC market. And so they were chasing deals. And I think there were companies that were ultimately SPAC'd into public companies that weren't ready to be public companies. And so I think a company does need to be able to go public the ordinary way, or else it's not going to succeed. And I think there were too many examples of SPAC companies that really weren't ready to be public, and that's why they haven't succeeded. And I think we're seeing a rationalization of that. I think we're now seeing a lot more scrutiny put on the companies that become part of a SPAC IPO. And I think the quality of companies that are going public via SPAC is much greater than it was even 6-9 months ago. And I think that'll be a trend. A SPAC will still be a viable alternative to going public. There are benefits to going public via SPAC, but I don't think the quality of company is going to be diminished versus a traditional IPO as it was maybe for 6 to 9 months there when the SPAC market was super hot.
Shepard Smith here. Thanks for watching CNBC on YouTube.